this is a mistake most people make, is they do not diversify. Diversification cuts your risk down. Now, in the discovery space itself, you should own 10 stocks. If you own 10 stocks and you have discoveries, good discoveries in 2 or 3 of them, you will create more wealth than you would ever believe, even if you lose in the other 7. So diversification of risk is critical to the discovery issue. So, you want to buy enough of each stock, but you want to have enough stocks to make sure in case something goes wrong. You need to then think about how much risk you want to take. Do you want to take a lot of risk? Do you want to invest in the early stocks that haven't yet made the discovery? Or do you want to invest in stocks that have made a discovery, but they aren't recognized by the market yet? So we call those more mature discovery stocks. Or maybe you want to invest in a significant oil company that's already made discoveries and is making more. At each level, you take more risk. And then for each stock, you figure out what's your downside. So now you go back to each individual stock. What's my downside and what's my upside? In discovery, you want your downside to be about 10 times less than your upside. So if you buy a stock for 10 cents, how much can you lose? You can lose 10 cents. But maybe that stock has a dollar potential, like the Canplatz example that I showed you, that actually was trading at 20 cents and went to $5 and now is at $2. So the risk reward there was very favorable. And so you do individual risk reward estimation for each of the stocks that you do. Then you have to get hands dirty. And this is a very traditional investment technique. It's not unique to discovery investing. Every good portfolio manager, every good analyst on Wall Street or in Toronto, they will do fundamental company analysis. And we use a 10-point grid, I'll show you in a moment, to delimit those points. So now you want to call the company, you want to read their annual reports, you want to talk to the directors, you want to go on a field visit with them, whatever it takes. Get on the phone and talk to these people and get to know the company so that you build some confidence in what they say and do. That's called fundamental company analysis. Then you rank them. I'll show you how to do that in a moment. In other words, what's my best name and what's my worst name? I've got 100 names in this thing. I'm going to pick the top 10, so I'm going to rank them from 1 to 100 and pick the top 10. And we use the 10-point grid to do that. And then you take the sentiment. It's like taking the pulse of the market. The sentiment analysis is like taking the pulse of the market. And just think about the market today. It really is a horrible market. People are afraid in the market. As I give you this lecture today, the sentiment is very negative about whether we're going to recover, when we're going to recover, whether we'll have inflation, whether we'll have deflation. And so lots of times the sentiment is, and again I mentioned the contrarian aspect of this, it's a good time to invest when the sentiment is negative because the stocks are cheaper. Then every week you want to rebalance your portfolio because things change. Even though you like a company and you fall in love with that company because you think that they're going to have a great discovery, you have to continue to do this 8-step process almost continually, once a week, once a month, whatever you feel comfortable with, but frequently and continually so that you rebalance your portfolio. And some names get better, some names get worse, and then you buy and sell according to that. Finally, last but not least, perhaps most important, this is your roadmap for selecting each stock. So we talked about asset allocation, we've talked about sentiment analysis, we've talked about risk analysis. Now we're looking at the individual security. And here's how the grid works. So this is the 10-point discovery grid, and this is my analysis, but I think it works beautifully, and I've had quite a bit of success with this. First question you ask, very simple question. Is this discovery, whether it's a resource in the ground or whether it's an intellectual property, we call that an IP, or whether it's a new technology, does this have world-class potential? If we're talking about gold, is there possibly 10 million ounces here? Now you can't know that ahead of time, but you can ask the question, and you can figure out whether you have the potential for world-class. What does world-class mean? Exactly what it says. It's the best in its class. And if it is there, it will be worth a tremendous amount of money in terms of the stock price. The second question is very simple. What is the percent project ownership? Does this company own 100% of this with no encumbrances, and they have 100% of this project, and so there's no dilution in the project itself? I like to buy projects that are owned 100% by the company. Now, a lot of companies will joint venture with another company, and they'll end up being at 20% or 30%. But you really don't want to be there because you're going to be diluted down if you are. So you want to have companies that own 100% of this. The third question is, and I think this is kind of an important one, what I really want, because there are thousands of stocks out there, I want to have stocks that have game-changing, immediate potential. Okay, what do I mean by game-changing? Give you a couple of examples. Is this a possible cure for cancer? Yes or no? I mean, you don't know ahead of time, but is this discovery, this gene discovery that was made at the University of Waterloo, could this be a cure for cancer? And if the answer is yes, it could be, but we don't know yet, then that's got game-changing potential. That has the potential to change things dramatically. And just in the biotech space, you know that even treatments for cancer today that allow a longer life of a month to 2 months to 3 months are worth billions of dollars. Or maybe it's a food technology. Maybe it's a technology that makes it easier to grow wheat. Does that have game-changing potential? Absolutely, it does. This is a fun question to ask. This involves you with the process of discovery. And then I think the fourth question, and I try to keep this as simple as possible. There are actually 10 points here. You've got to get to know the management and the board of directors. Extraordinarily important. Actually, you make a lot of contacts if you do this, and they normally will answer your questions. Do they have a good track record? Has this management team been successful in the past? And do they own the stock themselves? Are they going to be in it with you as you go down the road here? And as they create wealth for themselves, they're going to create wealth for you. And are they buying? There's quite a few questions you can ask here. But are they buying the stock? That's a very, very important aspect. Now, when you look at a company, you ask these 4 questions and stop. And if the answer to these 4 questions is yes, then you go on. If the answer to any of these questions is no, I think, you put this stock aside and say, I'll look at it again, do some more work. But right now, these are important questions, and I'm not getting the answers back that I want to get here. So that you simplify the process a lot. You don't have to know everything about a company. If it's not a world-class asset, if they don't own it all, and if it doesn't really have game-changing potential, and if the management team isn't top-notch with a good track record, you're wasting your time. So that, we try and simplify this process. Now, there are 6 other questions, and we'll go over these later, but, it's not really important, except that one of these questions I allocate 10 points, and I add it up, and so you get a score out of 100, and then you just simply sort all your stocks based upon their scores. And that gives you a very rough idea. So there are 6 additional points on the 10-point grid, but I'm not going to focus on those tonight. Yes, they're important, but what I try to do here is allocate up to 10 points for each one of these for each company, add them up, very simple process, take the total score for each company and sort from 1 to 100. And the ones that come at the top of the queue, then you get serious about those companies. Those are the companies you might want to buy. And financial soundness obviously is very important. Sustainability, because normally early in the discovery cycle, there's no cash flow. You've got to take that into consideration. It's a very important thought. But these are the 10 points on the 10-point grid, and believe me, if you do this well, you'll have a lot of fun with this, and it will work for you. Okay, now there are 3 classifications in my model of discovery stocks, and they're based upon the risk to reward trade-off. So if you look at the incubator section, and I'd just like to point out I own